everyone, welcome back to the Future of Finance podcast. I'm your host, Marissa Wood, and today we're going to be sitting down with clients of mine, Sarah and Eric Taylor, and discussing how they got on financial cruise control by the age of 40 and sharing some strategies to help you do the same. So welcome, Sarah and Eric. Thank you for
Thanks
coming.
for having us.
Thanks for having us. Yeah.
Absolutely. So, you're clients of ours, but I'm a client of yours. Sarah is a licensed massage therapist.
Yes.
And also, we live in the same neighborhood.
Yeah,
and
we
so
have a
see each
lot
other
of intertwining in our paths. We both work out of Four & Co. Yeah, it's been a journey watching our lives intertwine.
Yeah. And you guys, I always say you are like golden clients of mine because you're really doing everything right along the way. And it's awesome to see we're laying such a really strong foundation that, I think you're going to be lifelong clients and you're going to be really, really successful as well. You already are.
Thank you so much.
And so I always like to start out with how we met. And I think we actually have a kind of funny story. I don't know if Eric even knows this story, but I'll share it.
Yes, go ahead.
And so we were in the Bexley
Working women,
right, group?
networking group.
Yeah, which is just our community that we live in. And a couple women would get together for a happy hour or, just
mid-morning
lunch
brunch.
or
Yeah.
brunch, and just share kind of the struggles we're going through, some challenges, some ideas, just use it as networking. And the one event that they had was a happy hour event, and I was running late the one day, and my husband had just bought a new truck, and I'm, rushing out of the garage to get to this event. I back my car into his brand new truck. And I'm like totally frazzled. I'm like, I don't know, should I even go to this event now? I'm all worked up. I ended up going. And, the first person I see is Sarah, who's just beaming and full of good energy. And I think you were telling us all kinds of really great stories and sharing your passion with your upcoming business launch.
Yeah.
And it just completely changed my mood. And it really had
I didn't
such an
even know
impact.
that.
It really did. And like from that point on, I was like, okay, there's a reason I met this person. There's a reason I ended up coming. And it's really turned into like a friendship and a nice business relationship. And so
Yeah.
thank you for that.
You're welcome. And I remember
Sorry, Matt, for your truck.
Yeah. I remember this blonde hair coming through the doors of the hotel bar area because we were down at Spring Hill. And this wild look in her eyes. And I'm like, there is a story that goes along with that.
Yeah.
And little did I know how different of a demeanor you had that day than you normally do, because you were not the reserved, poised person that I have come to know. And I didn't even know that I gave you what you needed. But I do vividly remember that moment of you just being like, and we had a good laugh about it.
We
and I
did.
think that that transition from stress to joy can be such a powerful transition for moving through an emotionally trying ordeal. So I'm happy I was able to help you do that.
Yeah,
and it
thanks.
really has blossomed into a really great friendship and partnership, and we educate both of each other on all of the things that we know so well and live and breathe. So it's really been cool. to
Absolutely.
experience that.
And so, Eric, we'll get to what you do for work as well, because you both have, a financial background, which, is one of the reasons why you're such educated clients and successful. But Sarah, you have your own business, Stay Well Massage,
Yes.
and it's thriving. And only 2 years?
It's been 2 years. It's been 2 years and a
Crazy.
month since we moved in here. And that was when I opened this business.
Tell us more about, your passion behind wanting to open that and kind of how things fell into place.
My massage passion started as a senior in high school. So being 41, that was quite a while ago. And I did my senior thesis in high school on a local massage business. And then coming out of college, I went to school for massage and really realized that I was kind of put on this planet to do this. It was more than just a passion. It was something that came very naturally to me. And then, 18 years of working in other jobs and always having that in the back of my life or in the forefront in some cases, I collected knowledge from people along the way on financial planning and business tips and tricks and everything. So as I was dreaming this business up for 18 years, all of those little thoughts were formulating in the back of my mind on what I wanted it to be, even who I was as a massage therapist. And one of the reasons why the passion has become such a successful business, what I believe, is that I was very humble and almost in overwhelm at points in planning the business. And I realized that I knew a lot about the things I knew a lot about, but recognizing when I didn't and finding those like resources and the people that were centers of those areas and leaning on them or outsourcing to them and putting my pride aside and accepting like, I don't know enough about this was really a powerful shift to being successful because you don't know the questions you don't know to ask. And a lot of the people that I leaned on, whether it was podcasts were a big thing for me, helped prompt me to ask those questions. And then once I asked those questions of myself, I was able to drill down a little bit more detailed on what I wanted that component of my business to look like. And when I launched, I hate change. I think everybody hates change. So when I launched, I had thought everything through very thoroughly. And to this day, I haven't changed anything. And that's not because I haven't like there wasn't any change that was necessary. The only thing I've changed is added to my skill set.
Right?
Yeah. And hours.
Yeah.
Yes. Finding that work-life balance.
Okay.
But yeah.
So what would be some tips for someone that, wants to go out on their own venture and launch their own business? Do you have any things that you would definitely recommend them doing or definitely avoid doing that first year?
Yeah, so definitely find a resource where it outlines like the steps to opening the business, like all the components. Do you want a website? Do you want online booking? Do you want a customer facing storefront? Like, what do you want your business to look like? And write down the things within that landscape that you know how to execute. And then put yourself into that when you need to feel that joy. And when you're starting to feel as if you need to look a little bit more towards the things that you don't, as soon as the overwhelm hits, you know to lean on a resource. But having an outline of all of the details that you need to have helps you to narrow down the areas where it might come easier to you and might be more difficult. And knowing that you just don't know everything.
Some of the things that I've noticed, being a client of yours and knowing a lot of people that are clients of yours, you really do try to customize that experience from the music to the aromatherapy to, do you want the shoulder heating pad ahead of time or after? What do you want to drink? It does feel really customized. And I think that's what everyone wants. We all want to feel understood and like, in any business, even in our business, we want to feel understood and like we are an important client. We're not just another number or another transaction.
Yeah, you're a person. And like just like financials need to be specific to that person. I feel like in massage, too many times the provider is looking to do what they do for other people and they don't customize. That's the biggest complaint I have is that they feel as though the massage therapist is just going through the same routine that they did on the last person. And not only would that get boring for me, but that's not helpful.
Absolutely.
If you did the same investments for someone at a different time in their life, it wouldn't be appropriate as what you're doing for us. So everything in life needs to be a little bit customized to the individual or it ends up falling short of a need in some way.
Sure. Absolutely. Now, Eric, you work in risk management, kind of the financial sector, and I know Sarah always worked in the financial sector before. moving into massage therapy. Tell me a little bit more about, kind of your investment philosophy. Where are you more of a spender, a saver? What's important to you when it comes to saving and investing for your future?
So, from an investment perspective and as a risk manager, I feel like your typical risk manager is a no person. No, can't do that. Too risky. My philosophy, and Sarah hates it, is no risk it, no biscuit. So
Okay.
the instead of no, it's how. So for me, risk management is all grounded in strategy. What is my objective? Is this action going to help me achieve my objective, or is this wasted energy, wasted resources? So really defining the strategic objective, and then how can I achieve that objective, and what are the things that could prevent me from achieving that objective?
So you are somewhat of a risk taker, but you want to make sure that you have a safety net or you have some risk mitigation tools laid out at least.
Correct. So
Okay.
I understand based on the strategy, the levels of risk that I'm willing to take, and can optimize the choices based on that.
So when Sarah decided to, start a business as a risk manager, did you say, okay, well, we need to have X amount in reserves first, or we need to know, exactly what your expenses are going to be and can we cover that? Is that kind of how that conversation went?
To a certain extent. So I've been lucky enough that my salary covers the necessities. So we had the luxury of her business, of having the ability to fail without any material impact. So
That's good.
Yeah.
the threshold for that was cover your rent. If
Yeah,
you
it was
can
very
cover
low
the
bar for
Okay.
me. I had a much higher bar for me than he had for me.
Okay.
He was like, just don't lose money. And I was like, really?
You're like, you have no idea how
Yeah.
good I am.
You have no idea my plans here. And when I finally did let him in on the plans, he was, I think, a little more surprised at how ambitious or how into my numbers I was.
Okay.
I mean, you have the accounting background, so I knew that you would understand the things that go into operationalizing the idea.
Mm-hmm.
So being able to take that and truly know where you needed to be at from a client supply perspective to be able to have that
Yeah, like I
threshold met.
knew the number of clients I would need in my book to hit the numbers that I wanted to hit. I just didn't know how long it would take me to get there.
Okay, but that's so important because I think a lot of people don't even know their own metrics.
Knowing your numbers is one of the things I have listed.
Mm-hmm.
You have to know your numbers.
Mm-hmm.
And you have to look at them in different ways, in every capacity, even as the business that is our household, like knowing your numbers and like knowing how they change over time and what components are your biggest variables is a big thing to running a successful business, running a successful retirement plan, etc.
Absolutely, absolutely. Recently I've started telling people that because people will, pre-retirees and retirees will say, well, can I retire? I want to retire by 62 or 65. Retirement is not an age. It's actually a number. It's a dollar value. You can be 65 years old, and if you don't have enough assets, you are not retiring. Versus, someone could retire at 50 if the dollar amount is there. And so that's, that really is the mindset. It's a number. It's not an age, really. And so, one of the investment strategies I want to talk with you both about, and it is one of the first things that we implemented together, is rolling over a 401k. Why it's important, even if you like your current 401k or it's performing well, or you have, a decent investment background, which Eric, you did, you still do. And when we first spoke about this, Eric had changed jobs a few years ago, and we discussed the importance of repositioning that into something that's going to be actively managed. And one of the strategies we spoke about is having dividend paying stocks inside of that. and reinvesting those dividends to still take advantage of dollar cost averaging. And for our listeners that are not familiar with what dollar cost averaging is, that's when you're buying in on a consistent basis. Usually when it's a 401k, you're buying in every 2 weeks because that's when you're contributing to that 401k. So every 2 weeks, you're buying in shares. Dependent upon what the price of the shares are at that time, you might buy more or you might buy less. But throughout the course of the year, you're going to have an average share price that's going to be lower than someone adding to their account one time a year, subject to wherever the market is that day.
Yeah, so I think the concept of dollar cost averaging is so powerful because often you're putting in the same dollar amount on a predetermined schedule. So when the price per share falls, you get more shares for the same money at the lower price. So effectively, your average price is better because you're buying more. That is the day the market falls. I'm like, oh man, I hope it's payday. I hope I'm putting money in today to the 401k because that whole buy low, sell high philosophy plays really in your favor when you're putting money in on a consistent basis.
Which is why it's a problem when someone leaves their job and they're no longer contributing to that 401k. And if it's not being actively managed, which I got news for you, any one part of a big company, it's not. By having some dividend paying stocks that are being reinvested rather than paid out to you, you're buying new shares on a consistent basis still.
Even though you're not putting money
Even though
in
you're
on
not
a regular.
working.
Yeah. So often under the 401k plans, you have a targeted fund that is set for your retirement age. And often in those targeted funds, because retirement is so far off, they are more aggressive, but they're not dividend yielding securities.
Correct.
And, one of the misconceptions is that a 401k needs to be reallocated at the moment that you move it to someone. The reality is you often transfer it just the way that it is without selling anything until it's at the new location. So just because you've now put an actual advisor and face to your 401k asset, which is now a traditional IRA when you roll it over, doesn't mean that you need to change any of your investments. It just gives you the ability to do so much more easily and with a person that you now are working with on strategizing.
Exactly. Not a taxable event, not necessarily even an event where you're selling anything or, changing the funds that you hold. Absolutely, and I appreciate that you both understand that because, we all change jobs constantly. Well, not myself, but most of our clients change jobs constantly. And the other aspect is, consolidation and organization of all your company retirement plans, right?
Right. So the culture that we're moving into with the younger generation, they're not staying at their jobs for 20, 30 years. There's no pensions involved that they're leaving behind. So every time you leave a job, presumably you're leaving your 401k behind. What's the likelihood that you're going to forget you have that money? Like you move, then you have to change all of those addresses on all of those little amounts. And if you have a financial advisor that can roll over each of those 401ks into one traditional IRA for you, you only have one account that you need to keep track of. And they're not all in different places with different companies. It's a organizational thing as much as it is an accessibility to the money and putting a face with it as well.
And there's a financial impact too. Typically, the 401ks do have fees associated with them that a lot of times are picked up by the company. That when you leave that company, they're no longer paying those fees. So if you're not paying attention to it, typically there is a quarterly management fee.
And you can
associated with
eat
those.
up a little 401k pretty quickly with fees. And why
I
pay fees?
guarantee you,
don't have to?
99% of our listeners did not know that.
Yeah.
So thank you for shedding some light on that. Now, another strategy that we've recently implemented in your plan is utilizing fixed index universal life insurance, permanent cash value life insurance that has living benefits you can use while you're still alive, the best kind of life insurance. Now, you both felt as though it was a great fit inside of your portfolio. Can you kind of share with me why you felt that way, what you like about it?
So first, I think it's important to recognize that I was in the financial industry for 18 years. And this is one of the most powerful reasons of me acknowledging what I didn't know. I had been removed from the industry for 5 years when I met you, and I didn't know all of the new options that were available. The financial industry is constantly creating new products, and this is one of the things that I would have had no idea was available unless I came to you and admitted, hey, I haven't been connected to this industry. I know it, but I don't know it now.
Okay.
So you want to talk about why it's such a good fit?
Yeah. So I mean, from a strategy perspective, as we age, we're collecting assets and being able to protect those assets. For me, as the primary salary driver that covers the expenses, if anything happens to me, I want to make sure that Sarah and the kids are, financially benefited.
Well, not benefited, but they can
Taken
stay
care
afloat.
of,
Yeah.
Yeah. So that they don't have to rush to sell the house and liquidate the assets if there's anything that happens to me. So it covers that base. It also sets the groundwork for the base layer of the retirement strategy. So having a certain amount of income that I can count on for ever, that don't need to worry about market fluctuations, asset allocations. It's just there. It's a piece. It's
No taxes.
one
No
one leg of the stool.
taxes.
No taxes was a big piece of that. And then the other, as that asset grows, we have the ability to borrow against that and pay ourselves the interest instead of to a bank.
Absolutely. Yeah. I mean, when we say risk mitigation, it checks off everything. It's protected from creditors, lawsuits, taxes,
It's also
inflation.
hidden under FAFSA. So
Very important
our
for-
kids will probably
Yeah.
not. We're lucky enough that our kids will probably not have to worry about.
And they're brilliant, so they might get,
Yeah,
the
but
STARS scholarship.
it's just helpful to know that a
Yeah.
little bit of it is sheltered.
Absolutely. I mean, yeah, for those with children approaching college age, not only can you use it to borrow against to pay for their college if you want to assist them with that, but, it's an asset that you can, shield from that FAFSA microscope.
Analysis. Yeah.
Absolutely. I mean, for anyone that's in their 30s and 40s, using cash value life insurance to plan for retirement while build assets, have that death benefit, it really checks off so many boxes. And we've been trying to incorporate it in so many plans if, the finances allow it and your health allows it, because ultimately not everyone can get this because it is life insurance. But, I'm thrilled that you both see the value, and, I think you're going to really love it in the future when you can start pulling that tax-free income. That's an awesome conversation to have.
Yeah.
Now, the other major thing that we recently accomplished together was doing your retirement analysis, cash flow projections for the future. And, I don't know that everyone is even aware that this tool is out there for them. And, just to give our listeners a little background, it's essentially a snapshot that we can project out into the future. We plug in what your expenses are right now, what your assets are right now, your income right now. So everything, currently. And then we project it out with inflation to see, are you on track to be able to cover your expenses in retirement? Is there going to be a gap? When do we project those assets running out, if ever? And so that we know, okay, we have the next 20, 30 years to make the changes that we need or not. Or we can go, we're on cruise control.
We're on cruise control.
And, lucky for me, lucky for you guys, when we had that conversation, it was, hey, we are completely on track if we just keep doing exactly what we're doing. So, tell me about how that made you feel and what the experience was like putting together that plan.
So the experience of what it was like, I'll leave to Eric because he does all the work in getting all of the information to you, which I really
Yeah. Was that a
appreciate.
challenge, Eric? I mean, it was a lot of info, I will
It
say.
was a lot of information. If I didn't have it organized and already sort of structured myself, it could have been a decent homework assignment.
Because we send out an Excel document and you're plugging everything in, which, it
But
actually
again,
is
it
a
goes
good
back
exercise,
to knowing
though.
your numbers.
Yeah,
If you know your
because-
numbers, you know what you need to know, or
And if
at
you
least
don't
where
know
to find
them,
it.
now you got to know them.
And that's always a great exercise for people. It's like, okay, wow, I really could pay attention. And it can be your first step to organizing everything. Once you have it organized for you, it's organized for yourself as well.
Yeah.
Right.
And so,
So
let's talk about how you
it made
feel.
me feel accomplished. So starting in the financial industry, coming out of college, I was seeing all of these people that maybe, they were a little older than we are, but getting to this point where they're like, wow, like all that work, all that hard work that I did, like has paid off. And like, here's what I have to show for it. And that sense of accomplishment at our age was amazing. And it also made me feel relaxed. It takes the pressure off. So Eric didn't put any pressure on me with the business, but I put it on myself. And now looking at our finances, I can relax and enjoy this moment a little bit more, and to be able to enjoy the moment when our kids are still so young and not have to stress about it is really, really nice and relaxing.
That's good. Because, I mean, we even overestimated some of the expenses, which, it's important to do that because some months you're going to spend more. But, it's a testament to starting early. You both started saving early. And so now you're not going to be in your 50s saying, oh my gosh, we have to really
play catch up
and start doubling down. No,
we
if
have the benefit
anything,
of time.
You're really going to have a lot of surplus in your 50s and 60s because you already put it away. And, now it's just sitting there compounding.
Yeah. The benefit of time. That was my biggest note, was starting the 401ks young and not even noticing the money missing.
Yeah, I mean, sort of that cruise control perspective is having those things deducted as early as possible. So 401k, having it come out of your paycheck so that the only money that you see is already, incorporates that, savings into it. So having that, and a lot of 401ks will also allow you to increase your percentage contribution annually, and typically tied to merit increases. So where I want to increase it 1% every year, my salary might increase 2%. So I'm still seeing a salary increase. I'm also increasing my savings percentage, and I'm not feeling the impact of putting more money into savings.
That's a good tip, adjusting what you're saving as you start making more, because a lot of us, we suffer from that lifestyle inflation where we start making more and so we start spending more, but we're not saving more also. And it's about that balance. I want you guys to spend and live the lifestyle you're living, but just, let's make sure that we're still hitting our savings goals, which I know you guys will.
But there's always room for improvement too. And there's always room to put yourself a little bit under a microscope, or take a pause on the Amazon orders for like 2 weeks and just be like, you know what, let's see. Like if I pause.
It's a challenge.
It is.
Yeah, challenge
but
yourself.
Practicing that is really, really helpful. How did you feel?
So from my perspective, there's the risk management aspect of it. So at this point, we have essentially the coverage that we want to retire comfortably at the age we want. So now the potential, the likelihood of impacting that base is low. So my risk appetite goes through the roof, and I can see what asset categories am I not invested in? Are there things that might be a little bit riskier but have a higher reward potential? Those are the sort of things that we can do to say, okay, I have my set age, by the time I'm this age, I'm going to have this kind of income. Can I move that needle earlier? Can I go from 65 to 62? Can I go from 62 to 59? Like how far can we push that needle, and what are the things that we can do with that?
And
So
that was
it kind of motivated you to
do better.
do better.
Mm-hmm.
Yeah.
Which
and
is cool.
It's funny that he even says that, because that was my entire drive to hitting my numbers more. Because he's like, okay, well, just break even. Because we did an analysis 6 years ago similar to this.
Yeah.
And we saw that we were basically there already. But I'm like, but if I make more than break even, I can move his retirement age earlier. I'm
Which is
like, I want
awesome.
more time.
Or you could spend a little bit more now. You can do, you know, those extra cruises. You can do, you know, those extra trips with your family and spending.
And
which
we're
is
doing
great.
about 50-50 of that.
That's good. No, that's really good.
Because tomorrow's not guaranteed. And I think that
Exactly.
that's also an important component of this financial plan is, yes, planning the best, but also mitigating the risk of if tomorrow, unfortunately, is not promised, everything's going to be okay. And that is where the value of the life insurance was for me. I didn't realize how much I was worrying about what ifs until I didn't have to worry about it anymore.
Yeah. The perfect plan prepares for what if I die too soon? Okay. And what if I live too long?
Mm-hmm.
You know, like we have to find that balance of saving and spending. Absolutely. And now that we have that plan in our software, every year we can update it based on, you know, what you've saved that year or how well the market's done.
Mm-hmm.
You know, we can adjust it and update it and tweak it now that it's in there. And so, you know, making little changes are easy now. And, you know, for anyone that is a visual person and wants to see, am I on track? What will I have, you know, if I keep doing exactly what I'm doing 20 years from now, 30 years from now? You know, it's just a projection, of course, but it can give you that peace of mind to enjoy today a little bit more.
Or the drive to make some changes. It can
or it might be a
highlight
bad
Right.
bad forecast, and we say,
I've seen some of those, but the empowerment of knowing where you might be hemorrhaging more money, like knowing that a pause on Amazon needs to be longer than 2 weeks, like is a powerful tool to not sticking your head in the sand for too long. The sooner you do it, the sooner you can make the changes to shift everything in the right direction.
Absolutely. Yeah. And I mean, I thank you guys for shedding that light, because although you are very successful, I think a lot of our listeners will relate to you and feel like, okay, you know, I'm in a similar situation. How can I get on that cruise control too?
Yeah.
And so now what I'm going to start doing on all of our podcast episodes with guests is I want to ask 2 questions. You know, your best financial decision you've ever made and your worst. And you can answer this together or you might have separate ones. And of course, you know, we're not going to judge you for your worst.
Oh, no.
This is a relatability question.
Yeah. I'll go first with my worst because it's interesting. So one of the big things we talk about with financials is time, taking advantage of time, managing time, like it's a constant. So it's very easy to look at as something that whether or not you can control, but timing is another component. And my worst financial decision ended up not being as terrible as I had initially thought because of time. So I bought a condo in 2007. And in 2008, the mortgage crisis happened. So not only, and this is, so the short is I used an interest-only mortgage to get into my first property. And at that time, I was very young and much less educated than I am now. And I look back at my 20-something-year-old self and I wonder how I didn't understand interest-only mortgage was me paying interest only. Like, how did I miss that?
A lot of people were doing that though at that time.
Well, it was a good way to get in to what was presumably a rising real estate market. And the assumptions were that the value of the home was going to rise, that my income was going to rise, that I would be able to pay more on principal separately, but trust was the barrier for me there. And trust, But verify is now my new motto. So trust, but educate yourself. Yes, I can lean on you because you're the, subject matter expert, but I'm still going to do my own due diligence. So buying the condo, the bottom falls out, but time. And time is a beautiful thing. We still own the condo.
Okay.
And the benefits that we've gotten from that, going through COVID, I ran a 401k from my first job, basically started it right around the same time that I bought the condo. And I ran that 401k parallel and I forgot about it until it paid off the condo.
Wow.
So I got out of what I had refinanced into a 30-year mortgage by just wiping out my 401k under the COVID withdrawal parameters.
Which, important to note, the 10% early withdrawal penalty was waived during COVID. It is no
Yes.
longer waived.
Yes. And that, like I said, the benefit of timing. We had refinanced out of the interest only before that, but I was still in a 30-year mortgage chipping away at something. And it was our highest interest rate for loans. And we just decided, you know what, this was a good trade-off. So not as bad as it could have been thanks to time, but I'm grateful that that was my worst.
Yeah,
If that's
it's
the
not that bad.
worst,
No.
that's right. Buying real estate at 20 something, it was my worst decision.
Yeah.
Like, I don't think that's necessarily such a terrible decision. But yeah, time heals a lot of those bad choices. If you have the grace of time, it can.
I
it
mean,
can
if
fix
if
it.
you have the luxury of time, it goes back to some of the things that we've touched on before, like with the dollar cost averaging, looking at the market now, it's been, I'll say, volatile. So having, looking at that, if I were to check my 401k balance and be, oh my gosh, I lost $7,000 today, well, you didn't because you didn't sell anything.
Exactly.
The value is down. When we refinanced the condo, the market that was available to assess against came back with an appraised value of $56,000 for a 3-bedroom, 1.5-bath condo.
Wow.
On the Bridal Trail in Connecticut, beautiful complex for $56,000. And, at the time I'm like beside myself with like, my car cost as much as that. How, how is this possible? And at the time it didn't matter because of the TARP plan. We were able to refinance it even though it was underwater. The rate, like Sarah said, wasn't great, but it was something that allowed us to, where if she were to try and sell it, she would have gotten a lot more than 56,000, but not nearly what it's worth now.
Yeah.
So being able to sort of weather the storms and have that base is
We had the luxury
extremely
of doing
important.
that. Yeah.
Eric, what would you say your worst?
The
was?
worst, I thought about a bunch of different things, and there were some cars that I bought that were not the brightest decision. It's like, oh, I got a Mercedes. Like, yeah, it was like just a money pit.
Yeah.
But I think the worst financial decision I ever made was I bought a case of beer, and that case of beer cost me like $100 because this was in college, hadn't paid attention to anything, didn't really understand how banking worked. So that case of beer overdrew my account, caused another check to bounce that wouldn't have bounced if I hadn't bought that case of beer.
Oh my gosh.
And that like $20 case of beer ended up costing me $100 because not only did I have to pay the bank for the bounce check fee, I had a fee from the person that the check was for. So
Oh my
that just,
That $80, you'd be
yeah,
retired now.
You're thinking, seriously?
but it
The
was,
Mercedes was definitely a worse.
That is funny though.
but
I love you.
it boiled down
It
to
is.
that like willful ignorance where,
And it's
you
all
know,
relevant at the time.
It is.
Yeah.
should I have known that I didn't have the money for the beer? Yes. should I have known that there would have been other consequences? Absolutely. But it was just that, concept that, that doesn't matter. Let me pay for it. I should be fine. And then, not paying attention to all the things that are happening.
That's amazing. I love that. I love that story.
Me too. I think it's a good thing to note though that early in your life is the time to make those mistakes.
Mhm.
And as long as you learn from them, you can end up
Clearly,
somewhere like
Eric's
we-
still thinking about it all these
Yeah.
years later.
And when he said it, I remembered my similar one. So
Oh
we
my
all
gosh.
do it.
Yeah.
But overdraft line of protection on a checking account is not something to scoff at. Have you heard about this?
No.
So some banks will allow you to have a line of credit that is linked to your checking account that it will draw from if you overdraft. And you have the same interest rate on it as you would a
It's
one.
typically a lot lower.
It's a lot lower than a credit card.
Okay.
But it buffers you from those $25 to $36 overdraft
And you
fees.
just ask the bank
Yeah, you
for
just
that?
ask for an overdraft line of protection on your
Interesting.
checking account. Because what we do is we don't put all of our money in checking. We have it in savings because it's
course.
yielding money. So you need that buffer if you're going to thread that line and approach that zero. But yeah, an
ODP.
ODP,
That's a
overdraft
great
of
tip
protection.
that I'm sure majority of the
Every
people don't
college
know.
student should have them.
Yeah.
And it should be, and the payoff of the overdraft line should be linked to their parents' checking account. Just a tip.
Great tip. Okay, so those were not too bad. Now, what would you say your best is? And you might not have made your best decision yet, but so far in life. There's a lot, I'm sure.
For me, it has to be, if I would make a recommendation to anybody else, something that they could mimic that we did, it would be hiding that 401k money from yourself in your early 20s. Looking back, you don't necessarily realize when you get your first job at 15 or 16 years old, you don't necessarily realize how low your expenses are at that point. And you do end up spending a lot of that money on what later is perceived to be frivolous things. Like my DVD library when I was like 21 years old was like on point. Do we even have a DVD player right now? Are all those DVDs still sitting in boxes because of the investment I made in them? If I had access to a 401k when I started at my first job at 15 or 16, or my parents had set me up with a savings plan that went into something that later I could make, let's say Roth contributions with, I would have been even more ahead of where I am now. So
starting early.
early 401k, like from the moment you sign those paperwork for your first job, sign the 401k
Or
paperwork
if they don't
before
offer
you
it,
even get it.
you can start an IRA,
Yeah, that
on your own.
pulls. Yep.
Yeah.
Start something young and start just hiding that money from yourself. You will never miss the $25 per paycheck.
Eric, what would you say your best choice has been?
So far, it's been the capitalization on timing. So when we bought our house, we signed the contract in November of 2019. This was before COVID, so the prices in this area were still relatively
You're going to
reasonable.
make me sick right now.
I'm
Yeah.
sorry. I'm sorry. I know.
The prices were still relatively reasonable.
Yeah.
The interest rate at the time in November 19 when we signed it was still great. I think when we had gone under contract, it was like 3.5. Then COVID happened. We were impacted by the impact on the builders because the builders in communities like this normally have like 10, 15 houses going at a time. So they'll have all the trade workers, sort of bouncing around. With COVID, they had implemented a rule where you could only have one trade at a time. So they had to go in and do the plumbing, then they had to go in and do the electrical, and then they had to go back and do whatever plumbing needed the electrical. And then it was a very critical path dependent process. So it ended up benefiting us in that even though it was completely different than anything that I had ever done, we ended up getting into the house about 2 weeks earlier than they had planned the build to be done,
Wow.
which had a perfect overlap of 2 days with the apartment that we were renting.
Amazing.
So it was out of the apartment and into the condo.
Not to mention your property value has doubled.
Well, that's icing on the cake.
Yeah.
The best part from the time that we signed the contract to the time that we closed was that with COVID, rates had gone into the basement. So I was happy with the 3.5 rate. It had gone down to 2.5 by the time that we closed.
Wow.
So that's just $80,000 to the bank that I don't have to pay.
Oh, my.
It doesn't impact the property value or anything like that. That's just more money in our accounts. Then, like you mentioned, with COVID, everybody wanting to get out of the city, wanting to have more of the suburban sprawl and space, and the property value has gone up
A lot.
quite a bit since that in
Yeah.
a very short amount of time. And I just look back that is part of that base. That's the essential piece of housing and comfort that we're paying a ridiculously low amount for, that even if we were to try and replace, I think if we were to purchase our house now, the expense would be quadruple what we're paying now.
Yeah.
Yeah.
Thank you. That's going to be me.
It's Eric Taylor luck. I just hitched
No,
my cart to the right horse.
It's amazing. And I mean, no one can time the market, whether it be the real estate market or the stock market, perfectly. But there's going to be points in your life where things do work out perfect. And that's awesome. We got to celebrate that. And, it couldn't happen to better people. You both deserve it. And so that's kind of, rounding out your current strategies that have gotten you on financial cruise control. And, I hope to our listeners that this inspires you. And if you have questions or you want to, see if we can implement some of these strategies for you, we'd be happy to have that conversation. Now, with Sarah, with Stay Well Massage, if any of our listeners, are local to the Tampa Bay area and want to get in touch with you, how can they reach you?
So I have a website that kind of details a little bit about me and all of my services and who I really customize best to, who my ideal client is. And it's staywellmassage.net. And there's book here buttons all over that website that will launch you into my online booking. And you can see my schedule. Just know I book out in advance.
She does.
So plan. If you're not a planner, you're not a good fit for me, unfortunately. But there are always those last minute available options. And I do have a wait list.
Awesome.
So if you want a last minute appointment, I have a wait list as well.
Great. Well, thank you so much.
You're welcome.
So thank you both for coming. And for everyone that was listening today, thank you so much for tuning in to another week of the Future of Finance podcast. If you have questions or want to schedule a phone call or meeting with me, feel free to go to our website, union-financial.com. You can click the book a meeting button and it'll take you right to my personal schedule and we can schedule a time that works for both of us. And I'm your host, Marissa Wood. Thank you, Sarah and Eric. We look forward to seeing you all next time. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.